dovish noises out of the Fed and extreme bearish sentiment triggers a massive short cover rally in US stocks. The dollar pulls back to key support levels and energy commodities just keep charging higher. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 31st of May, and let's take a look at these markets. So last week, big old rally in equities, what everyone been waiting for. Really strong bounce. Now, we were coming from oversold conditions, obviously, as we've been flagging for a while, but that was probably true the previous week or two as well. So really, the thing that kind of got the bounce going was a combination of a couple of things. One was that the Fed started talking a little bit more dovishly than we've seen of late. With the likes of Bostic coming out and saying that they're potentially going to pause, or they should potentially pause in September, see how their hikes are kind of feeding through and the impact that they're having. That kind of surprised the market a little bit to the dovish side, and we started to see rates markets move in line with that. And then on top of that, you also had the month-end buying that I've been flagging that was likely to come at the back end of last week, given the long weekend and the lack of liquidity we were likely to experience today and yesterday. Yesterday, the US market was closed anyway, right? So that really got backloaded into last week and kind of fueled that really sharp 6% move that we saw in the S&P. Okay, let me share the charts. From a vol adjusted basis, we've got that sea of orange, obviously, all the equities up there. JP Morgan particularly stand out there with a 3 sigma up move. Some of those big cap techs as well, in terms of top performers from a vol adjusted basis, Apple, Microsoft, etc. You can see obviously on the rate side, US rates, China rates, all kind of down a bit. The US rates curve didn't move too much, but the front end of the curve was down like 1 standard deviation. Dollar obviously pulled back as well, just sort of in line with the risk on tone in markets and the more dovish sounding Fed. And then what else did we see? We saw oil obviously up a little bit, but that was really the only commodities that were really moving with the energy ones, right? So that was up 1 standard deviation, but pretty benign if you look at the rest of the commodity space. And then finally, crypto, whilst Bitcoin was not a lot going on, Ethereum was down 1 standard deviation and altcoins were beaten up quite badly. So we'll talk a bit about that when we do Crypto Insight. Okay, so that's the kind of summary for the major moves. Oh, one last thing to mention on the downside, credit spreads got crushed. So, similar to the squeeze in equities, obviously credit rallied too. So credit spreads came down a lot and looking at nearly a 3 sigma move in US high yield CDS there. So pretty decent squeeze there, pretty decent short cover there. Now, if we look at kind of what went on from a flow side of things, quite a lot of buying going on in equities, obviously. Bank of America put out their kind of flow data on a weekly basis. So you can see it's like the largest inflow in equities that we'd seen globally in 10 weeks. So pretty decent flow there coming in. And then you look at the tech flows, there were still outflows in tech. So whilst overall global equities saw like 20 billion of inflows, you're still seeing money coming out of tech from what Bank of America's flow was seeing. Okay, and that's likely because the rates outlook is still potentially a headwind. The start of QT literally tomorrow, things like that maybe are making people still not quite ready to jump back into tech. Yeah. Now on the retail side of things, they're not shy of jumping back into tech. And we'd been saying that the likes of JP Morgan were putting out data saying that retail, run out bullets. They'd kind of given back all the money they'd made in 2020, 2021, and they weren't really a big factor in the market anymore. And Goldman's data was saying a similar thing. Now, these guys at Vandatrack, their analytics outfit, and they are kind of begging to differ with that, right? And they've been doing their analysis. And they're basically saying that retail is still in the game. They're still on the bid. And particularly if you look at the breakdown throughout the day, and that's the chart on the bottom right, you get this retail buying activity in the last hour of the day where they come in hunting for bargains, basically, right? And they buy the market and you see these spikes into the close. And apparently those are being driven more by retail than by institutional money. Okay, so I found that to be quite interesting. You can also look at things like social media forums, like your Reddit forums, etc. Apparently, the mention of the market bottom is spiking, where people are basically hunting for buying the dip opportunity. So buy the dip's not completely dead in the retail cohort. Apparently, they may come to regret that in a few months. Who knows if some of the macro narratives that we've been talking about come true. But the retail still seem to be there apparently. In terms of the move, obviously we had anticipated that the flows into month end were likely to at least support the markets, and now we're going to be watching price action closely to see if that kind of just gives it all back very quickly, right? Because the move wasn't on a whole lot of volume, so it wasn't that hard to move the market up, right? Given the lack of liquidity that we've been seeing of late. There may be a little pocket of strength into June expiry. We need to kind of wait and see, I would say. But this week's price action will be interesting to see how quickly the rally fades, or whether we can keep our head above 4,100 on the S&P. Yeah. And the reason why we're fairly confident that it's not a fundamental rally and it's more of a short cover rally is if you look at the kind of who are the outperformers, right? And here you can see the most shorted basket bounced 15% off the lows, right? So, into Tuesday's low that it made, it rallied pretty much in a straight line 15%, right, into the end of the week. And like I said, liquidity has been pretty horrible. So liquidity has been pretty bad for the last couple of months anyway, but it's been getting even worse, right? And people were saying things like $10 million of delta is moving the market, right? That's how thin things have become. Which, sounds pretty surprising, but that's what the data has been telling people, right? So, I don't trade from the institutional standpoint anymore, so I can't attest to whether that number is true or not. But clearly, there's a lot of stuff pointing to the idea that liquidity is really thin, and so therefore, if the flow turns around, it can have an outsized impact on markets, basically. Yeah. All right, so then the big question is, the reason that's been blamed for that rally is the more dovish sounding Fed. So the question is, how soon can the Fed really pivot, right? I think that becomes kind of one of the most important questions, right? So to answer that question, let's have a look. So inflation break-evens have absolutely rolled over, right? So that is our sort of market-based best guess of what people anticipate for inflation going forward, right? Longer term inflation. It's a 10-year inflation break-evens are down from 3.1 to like 2.5. Okay. Now I would say part of that is due to people thinking that the Fed's going to break the back of inflation with rate hikes, and the other one is that growth slowing down, demand destruction, things like that, right? So it's a combination of the two. Thing is, we did get the PCE number on Friday, and headline numbers are showing slight cooling there. But you have still got the stickier side of inflation with a bit of momentum, as we've been mentioning over the last sort of few weeks, right? So Darius at 42 Macro put out this chart, which I thought was quite good. Basically, he's trying to ascertain when is the earliest that the Fed could actually do a proper pivot. So not just a pause, but actually a dovish pivot. And what he's basically saying is according to his models, we need to get under 3% annualized inflation on core PCE, right? And we need to be trending there for a few months for them to then be able to justify pivoting, right? So the earliest that's going to happen is November, right? According to 42 Macro. So that's still quite a long way away, right? That's still 6 months away before we actually get a real pivot. Now, that doesn't mean the markets can't rally before that and bottom before that, because they can price in the pivot before the pivot actually happens. That's what tends to happen. But just based on that timing, just be aware that the next 2 months, 2-3 months is still a long way before that, that they're going to need to see these lower inflation prints. And with the oil price breaking to new highs, not new highs, but above 120, that might make it more difficult for inflation to come in line with some of their projections, right? On the FOMC minutes last week, they were showing some pretty dramatic moves back down in PCE next year and the year after. So they think that they're going to get on top of inflation, and certainly their projections say that, which which gives you that argument why they might then want to pause. But we need to see that in the data, right? And the earliest we're likely to see that is kind of by November, right? So that's kind of what we're seeing there. In terms of you know, and also the other thing that could make them pivot, right, outside of kind of inflation just coming down and staying in that 2 to 3% range, is a full-blown market meltdown. Okay, in which case then the problem becomes fighting recession, and they probably will get sponsorship from Biden as well, and they will be able to pivot faster. But we're nowhere near that full-blown meltdown, right? That happens with the S&P closer to 3,000 rather than 4,000, I would say. Yeah. So then that leads me on to the next point, which is, you know, what is Biden going to choose, right? So that becomes the first. When can the Fed pivot? That's a big question. And then the next thing is, what is Biden going to choose? Is he going to choose inflation, or is he going to choose recession, right? And you know, we can all probably guess that recession probably polls slightly worse than inflation does. Okay. So he's called a meeting with Powell. I think that's happening today, later on today, to discuss the state of the US and the global economy. You know, so I think Zero Hedge were joking that someone's probably shown Biden the chart on the US economic surprises. That's this chart on the left, where in the space of a month, it's kind of crashed from 70 down to minus 40, which are levels not seen since last September. So that kind of just gives you the rate of change of economic data that's been coming out of the US. It's pretty ugly. And when that's dropping so significantly, it's giving you a sense that, yeah, we are heading quickly into a slowdown, basically. So that's one concern. Maybe that's what they're going to talk about. Then if you look at the chart on the right, you've obviously got stagflation kind of kicking in across the world, right? You've got inflation going higher. You've got economic growth forecast rolling over, basically. Right? So we are clearly the stagflation we're heading into seems to be accelerating, and these are things that they're gonna have to talk about and be aware of, right? If we start to see Powell confirm, you know, what they're saying regarding a pause, then we kind of know what Biden's been telling him, right? You know, it's kind of whilst I want you to break the back of inflation, don't throw the US economy into a really bad recession, okay? So it'll be interesting to see what kind of noises Powell himself starts to make coming out of this, because you did also have Waller yesterday saying about multiple 50 basis point hikes needed. So you are getting mixed messages out of the Fed. Bostic's not a voting member as well. So, you know, do you take what he said with a pinch of salt and just fade the rally? Or, you know, I just think there's a lot of uncertainty right now around the Fed's policy path. But the fact that Biden's called him in to have a chat, I think that's quite interesting. So the next thing that Powell says in public about it is going to be very closely watched. To start the week, you had a retest down towards, you know, 38.75, kind of chopping around, but then the acceleration really happened after the FOMC minutes and then into that month-end buying, and we really accelerated and saw, you know, a 6% rally in literally a straight line, right? So that's kind of, and that was that month-end buying that we kind of thought may well happen, right? Blasting through all these short-term resistances that I had mapped out, kind of blasted through all of them. And we're now kind of retesting this one down here at 41.25, right? So, you know, who knows how quickly this thing gets faded? Yeah, that's what we kind of need to watch for. I kind of fancy, given the move was so violent to the upside, you know, I think we may be able to eke out a bit more upside over the next week or two before we get some data that really spooks us. But, you know, if you look back at previous rallies over the last month or two, and when they've sold back off and how quickly it's happened, it's usually just been on the back of like a Fed speaker saying something hawkish and the market just gets nailed, right? So maybe that can happen again, right? Let's kind of watch out for that. I think keeping an eye on what Powell says is going to be important. Yeah. I don't think we're out of the woods, obviously, longer term. Whilst this may kind of hold up for a few weeks, I do think it's short covering. I do think the fundamentals are worse and probably going to get worse. The fundamentals are bad and are probably going to get worse. So, you know, I like fading this move. So obviously I've already got some sort of put spread colliery structures on in July. If anything, I'll be adding to those, right? I'm kind of waiting to see if we can push ourselves up towards 4250, 4300, which seems like a nice area to get a big short on. And then I'll probably add to those sort of structures, basically, maybe selling out calls at like 4500 and then buying some nearer put spreads or something like that, just rolling all the strikes up a bit. Yeah, that's kind of what I'm looking at. And then if we look at sort of what other equity markets did last week, the US was the standout performer, up around 6%, whereas you had Europe and Asia only up sort of 1 to 3%. But they have been kind of outperforming on the way down. So it makes sense they didn't quite squeeze as hard, right? Because the US seems to be the market that's really been unloved recently. Yeah. Okay, so that's price action in S&P. If we then have a look at VIX and what that's been kind of up to, obviously we've been flagging that VIX was underperforming on the way down in spot, and that was giving us a signal that things were maybe a bit exhausted. Now, obviously, that's come down, and that's come down in line with a lot of other cross-asset volatility measures, right? So if you look at the MOVE index, which is the rates vol, that's had a decent move down off the high. So that's coming down with the VIX. If you look at credit spreads, like I said, 3 sigma moved down on the week in US credit, high yield that was. This one's investment grade, but still a similar pretty sharp move back down in spreads. We've been mentioning skew has been getting crushed, and that was happening when the market was actually going down. That's this risk reversal measure from Spot Gamma, showing that going back towards neutral as opposed to elevated for puts. And then lastly, the kind of standout really, if you look at all these kind of risk barometers or risk measures, is the VVIX, right? So the VVIX is the volatility of the VIX. And that's often quite correlated to the VIX itself. So if you look at that line, that and the VIX, they kind of go hand in hand a lot of the time, but there's been quite a big divergence in them lately, where the VVIX is actually very, very depressed relative to the VIX, right? Now, historically, my sense has been the reason why that might happen is because people are more comfortable with the idea that they don't need to buy call options on the VIX as protection, which would give a bid to the VVIX, and they're just buying outright VIX futures, right? They have more conviction that vol in the low to mid 20s is well supported, and they need to have some of it in their book. When they're not so sure and vol could go to 15, then they might spend some money on VIX call options, right, as their hedging protocol, as it were, right? But when we're in the sort of environment we're in now, where it seems like quite consistently that 20 level has been a bit of a floor on the VIX, and maybe now even 20 to 25 is that zone where it finds buyers, there's less of a need to be buying optionality in VIX space. And that's basically keeping the VVIX quite low. That's kind of my explanation for it. Something I used to do when I was getting very long VIX back in the day, like in 2008, we were structurally very, very bearish on the market. We were owning VIX Delta via futures, and we were just overwriting it, right? Because if you're structurally long the VIX at 2025 and people are willing to pay you a load of premium for the 50 calls out to 1 month, why not sell them, right? Because if the VIX doesn't spike in a month, at least you've got some carry back, basically, right? So it may well be that that's what's going on, that there's institutional money that is parking itself in the VIX, given that bonds have been a horrible diversifier, right? People are saying, I need some vol in the book. It's one of the only things that is providing me diversification. But whilst I'm holding that vol, why don't I overwrite it by selling VIX calls, right? I don't know if that flows in there. I haven't seen it myself. I haven't seen anyone write about it, but it would make sense to me that is what people are doing, basically, because that's the kind of stuff we used to do when we were long quite a lot of VIX. Yeah. Okay. And then, with all these kind of risk, cross-asset volatility and stuff coming down, I'd look at it as a bit of a gift, to be honest, to help fortify your portfolio, if you haven't already done so, against the strong negative cyclical forces with regards to growth, inflation, and liquidity, right? We've been banging on about that for months. It hasn't disappeared. If anything, it's going to accelerate. So the fact that you get these short squeezes and these pullbacks in the vol complex, they kind of give you the opportunity to protect yourself and kind of make that portfolio more robust to those drawdowns over the next coming months, basically. Kind of sniffed out that there was going to be a bit of a correction, and it's carried on correcting. So that was, feeling decent about that. Kind of come into this level that I was anticipating around 101, which is kind of the top of the channel that we broke out of. So that was going to be the first support level. Seems to have bounced off it for now. If that breaks, I would say 99.5 is kind of another big level there. So I'll be looking for that to hold. Overall, I'm not sure we're out of the woods yet in terms of the dollar rally. I still think whilst the ECB has been, saying quite hawkish things, we are, and inflation numbers are just rampant, right? Here, German inflation data relative to the ECB's rates, right? So you've had rates just sitting there at 0 for God knows how long, and inflation is rampant at like nearly 8%, right? So they clearly know they have to do something, But the problem is, everyone's saying Europe's already in recession, right? Because of what's been going on with energy prices and stuff. So how much road they have to raise rates remains to be seen. The trade, the Bund BTP trade that was flagged by Alf hasn't really gone anywhere. I've got a little clip of that on. It hasn't really made or lost anything yet. But I do think once they get going on kind of balance sheet reduction and things like that, I do think Europe's going to stumble into a bit of an issue, and they're not going to be able to hike as much as maybe they need to. So that's why I don't think this euro strength is going to be very persistent. It might have a little bit further to go. Maybe we can push up to like 109 or something, but 108, 109. But I'll probably be reloading on downside if that happens, because volatility in FX probably would have come down as well. So you'll be getting some very, very cheap optionality to play another downside leg in euro if that was to happen, right? So if we look at oil, what's been going on there, obviously gasoline prices are still on the moon, driving season kicking off in the US, that, right? So driving season was coming, it was keeping gasoline prices bid. They're pretty much at the highs. This is one of the things that's driving Biden mad, I'm sure. And then, but speaking of Biden, I mean, the Strategic Petroleum Reserve on its knees at 35-year lows, right? So given that they've kind of done that and you've had no visible price impact on oil, I mean, that just shows that. I mean, I don't know if they hadn't done it, where oil would be. Maybe it'd be above 150, right? But the point is, even though they've done it, there's so much underlying demand, right? Despite China being in lockdown for a few months, right? That just shows how robust the demand has been in oil. Okay, so we've got global demand in oil. So you've had basically the rest of the world taking up the slack, right? For the and almost back to pre-COVID levels. So this data shows like the drop off in all the different regions, and shows that the demand is kind of back to pre-COVID levels pretty much. And then just basically gives you a picture that the oil demand's just not as elastic to price, right? Because there's just so much critical industrial uses of crude and crude products that even if the price is up significantly, right, there's still demand for it. Like, so the true demand destruction in oil doesn't come until much higher prices. I don't know what those prices are, but it wouldn't surprise me if those prices are closer to $200 a barrel than where they are now. Right, so that's kind of what we're seeing. Very, very robust demand, and China now trying to reopen. That's only likely to get worse, and we're starting to see a breakout here in oil. EU ban on Russian oil imports got agreed as well. Finally, they were back and forth, Poland and Hungary and stuff, and so seaborne imports are going to get stopped, which is about 2/3 of the imports. There's pipelines and there's seaborne. So about 2/3 of it is going to kind of get stopped within the next 6 months. And that's kind of helped oil kind of break a bit higher overnight. Brent's now at like 124 or something like that, right? So, breaking above levels toppy levels that we saw back in March. This could be the next leg up, basically. So it certainly looks that way from a technical perspective. Yeah. And then if we look at some other stuff on oil, this one here. So we've been talking about spare capacity just not being there, right? So here you've got a chart on spare capacity, looking like pretty much multi-year lows. If you look at spare capacity as a percentage of demand. So we already kind of flagged that, and the Saudis kind of started to make noises along the same sort of lines. And like I said, if there was enough spare capacity, these guys would be meeting their quotas basically, right? And they're not. Then you've got long-term demand side of things. This is all the different sort of energy supply and demand projections. Global energy demand likely to, go on that red line towards the end of the decade. And then these are all the different sort of forms of energy, coal, natural gas, and how the supply is likely to grow. And we're just looking at massive deficits going forward, basically, right? So, it just that fundamental supply demand picture just looks ugly. And that's why energy prices just can't seem to come back. They can't even have like a little downtick, basically, right? So it's because of this underlying strength in the story between supply and demand. Yeah. And then lastly, like I said, China lockdowns are kind of easing, driving season's beginning. Inventories are really, really low for this time of the year. If you look at motor gasoline inventories, Cushing crude inventories, super low. And throughout the summer, they typically go even lower, right? The fact that they're starting from such a low point compared to averages, and we're hitting this seasonality where you know, driving season, etc., usually draws down on inventory, we're not in a great place, right? And it kind of explains why prices are doing what they're doing. And then finally, the forward curve in oil, you see a discount, like a massive backwardation between the front that's trading at 115, 120 versus the back that's trading at like 70. When I say the back, we're talking 2 years out or something, right? So that's basically not incentivizing the producers to like increase capacity. Because if the longer dated contracts were trading at 100, then it would make sense for them because they'd be able to increase capacity and lock in these higher levels in the long end. But it's just the front that's trading at a silly level, right? So until those long-term futures kind of catch a bid, you're not going to get the extra supply coming to the market, basically, and things are going to remain tight. Yeah. So that's one thing to kind of be aware of, right? It's that extreme backwardation provides little incentive for people to spend capital to raise productive capacity, right? Once we get the other side of the recession scare, which we think is probably coming late summer, then maybe the long end of the crude futures will be in play, right? So maybe it'll be a case of you get this kind of move down, you know, you get this kind of flush out of risk, and then on the other side of it, you want to be buying those long-term futures that kind of get down to 50, 60, even if they manage it, then as a long-term trade, that might be a great trade to play those structural deficits in terms of supply, right? That might be the way to kind of play. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.